You've got questions, we've got answers. We have the man to answer them. Jeffrey Levine from Buckingham Wealth Partners. Jeffrey, welcome back to another episode of Ask the Hammer.
It is good to be with you as always, Bob.
Good to have you. Understand your inbox has some questions in it.
It is very full. Getting to be that time of year. Lots of questions. And this one comes to us from Gary, who says, I'd like to move money from our IRAs, I guess he and his spouse, to and 403Bs to each of our Roths to get ahead of the coming tax rate changes. I don't have cash to pay the tax at the time of the conversion, other than taking extra money to take out from my IRA. Is it still worth it? We're both retired and I'm letting my Social Security grow, and we can afford with my wife's Social Security and pension to let the Roth money grow. So it's a good question, Bob. And I'm sure, like many of them, it's going to come down to, it depends. And here's the deal. At a high level, in general, you want to avoid taking dollars from your own retirement accounts to pay for the cost of a conversion, because it's just either if you take it from the Roth IRA afterwards, it's lowering the amount that can grow tax-free. If you're taking it from a traditional IRA, as was proposed here, it's just adding more income that year and may make it less efficient to convert to a Roth IRA. Now, that said, a lot of people have done a great job saving, but almost entirely in a pre-tax account. And so if in fact your income is low enough that you can take not only the conversion income, but layer on more income to pay for the conversion tax itself, right? It's almost like a circular calculation, because if you take money out of your IRA to pay for the tax and the conversion, well, now you've got to account for more money to take out of the IRA to pay for the tax on the money that you took out to pay for the tax and your conversion. You got all that, Bob?
Say that 5 times fast.
Yes, say that 5 times fast indeed. But the point being is that if your tax rate is low enough, if your income is low enough during those years, and you expect it to be higher in the future, whether that be to, hey, we're going to have more income because of Social Security, or I'm going to have required minimum distributions, or I just believe I'm in a low tax rate environment and Congress will increase the rates at some point, or at the end of 2025, the Tax Cut and Jobs Act, lower tax rates will expire and I expect to go back to a higher rate then. All of those would be reasons to think that your tax bracket or tax rate today might be lower. And so, yes, taking money out of the IRA can still be worth it. It is not the ideal scenario, but if it's the only place to go, and if you add all the income together, you still think this will be a lower rate year for you, then yes, it can make sense to make that conversion.
Right. Do you think folks might have other options too, Jeffrey? Like maybe there's a home equity line of credit, or maybe there's a reverse mortgage, or maybe there's cash value in a life insurance policy, or something like that?
So whenever it comes down to that, I always say, like, is that really your only source? Like, are we looking at everything here? And that's a great, you bring up great points. Is it less expensive to get that cash from somewhere else? The home equity line, well, you know what, if I'm kind of a year or two away from required minimum distributions, maybe I borrow at a really low rate and I pay it back in a few years when I have required minimum distributions. And I know I got to take that income anyway, but I don't have to push my tax rate higher this year, or I can convert more because I'm filling up less of that bracket space with the money that I need to pay for the tax in the first place. So it's a great question. And look, in some cases, it might even be borrowing from family members, or, I kind of like, I wince when I say that, because like, oh, does that open a can of worms? But in the right circumstances, if there's trust, if they're, it can be, especially sometimes when the parents are doing it, maybe for their own children, they plan to leave them the accounts. If the children are in a position where they're in a high income tax bracket, boy, does it make sense to loan mom and dad money to be able to let them convert at their low income tax brackets, so that when the money is left back to the high income tax paying children, it's already tax free. I mean, it's a win-win-win for everyone. Again, yes, it does open up a bit of a Pandora's box. You've got to be cautious there, but in the right situation for the right family, that can also make a lot of sense.
Yeah. Well, answered the reader's question and my follow-up question, so I'm happy.
All right, I'm done. Let's go. Is it dinner time, lunchtime?
Yeah, it's time.
Well, that was a great question. And if you've got a question for us, great or not, send us. Let us know here at askthehammer@buckinghamgroup.com. Again, give Bob and I a shout here at askthehammer@buckinghamgroup.com. And we look forward to tackling your question in a future episode of Ask the Hammer.